Hello and welcome to the Global Forecast from the Economist Intelligence Unit. My name's Tony McMahon, and as ever I'm joined by Robin Bew. Robin, the earthquake and tsunami in Japan have been an appalling human disaster, but what's the wider economic impact likely to be?
Well, as you say, it's been appalling. We don't know how bad yet, and we fear that the death toll is going to be revised up extremely highly. In terms of the economic impact, I mean, obviously a significant chunk of the Japanese economy has been, or Japanese country has been devastated, and when you look at what that means in terms of the economy, there are lots of businesses which have just been destroyed, the workforce either dislocated or killed. So there's a very strong sense that in that part of the country there will be very little economic activity over the course of the next few months or so. Look more widely across Japan. It's important to remember that Japan, although it hasn't grown very much in the last 20 years, is still the world's third biggest economy and is extremely diversified. So there are areas of the economy which continue to function quite normally, and Tokyo is still operating relatively normally, although of course people are very concerned about the nuclear threat from the power stations, which are still in very unstable state. But there is a sense that things will continue to move. Rolling power blackouts are happening across the country that will depress manufacturing output, particularly over the course of certainly the next couple of months or so. But our view is that growth over the short term will be very weak. The economy will probably contract over the course of the next 3 months or so. But there will be a very significant reconstruction effort after that. So our forecast is moving around slightly. We've cut our forecast for growth this year slightly and revised it up slightly next year because of the construction boom. But I think it is important to recognise that while geographically the part of Japan that was worst affected will be very badly hit indeed, the economy is very big and other sectors will continue to perform and develop, and export trade will continue. And so while short-term disruption very high, in the longer term we would expect broadly things to continue.
And how do you think this is going to affect the balance of power between Japan and China? Does this in effect confirm China's economic ascendancy?
I'm not really sure it does. At the moment, of course, the situation that we see unfolding on TV screens is absolutely terrible. When you look at the revisions that we're making to the economic numbers, they're actually relatively small. The costs involved in the reconstruction effort, for example, are likely to be very, very large, but possibly not that large in the context of an economy the size of Japan. I mean, the Kobe earthquake in the mid-1990s, the reconstruction effort cost about 120 to 150 billion US dollars. This is clearly going to cost an awful lot more, but still very manageable, we think, in the scale of the Japanese economy, despite their very weak public finances, and the impact on growth relatively modest when you average out over a couple of years. Of course, the bigger story, as you imply, is the rise of China and the relative decline of Japan, along with many other Western economies or many other developed economies. That, of course, continues. China will grow by about 9%, maybe a bit more this year. Japan, we think, by 1.5%, which is slower than Europe and America, but really the difference between Japan, Europe and America is pretty small relative to the difference in all of those and what's going on in China, where China's growing sort of 3 or 4 times faster than the US is. So this doesn't really do much to change the long run story, but the long run story is absolutely China's ascendancy.
In the first half of this year, you expect the price of oil to continue to rise as a result of the turbulence in the Middle East, but in the second half you expect to see some easing. What scenarios are likely to give rise to this?
There's a whole lot going on with oil at the moment. Of course, the main thing is the disruption that we see in the Middle East, or the threat of serious disruption going on in the Middle East. Actually, what's happened in Japan is that the oil price has come off very slightly as people factor in the weakening of the Japanese economy, at least in the short term. But we think the longer term story is going to be that the energy prices remain high all the time, that the Middle East is in turmoil. Once the Middle Eastern situation kind of settles a bit, I think it's important to recognise that economic growth in many areas of the world is likely to be slowing going forwards, that fiscal austerity is going to start to bite in Europe. It will ultimately start to bite in America as well at some point down the road, and even in the emerging markets, because we've seen overheating over the course of the last 6 or 9 months or so, policies tightening in many markets, and that will slow economic demand in most countries over the course of the next 12 months or so. That will allow oil prices to come off a little bit. So some of the factors which are keeping prices exceptionally high will start to ebb away. But there's no doubt that we're in a world in which there's not that much spare oil capacity around at the moment. Demand has rebounded pretty strongly from the depths of the recession, and all the time there's not a lot of spare capacity. Oil markets are very vulnerable.
While all eyes have been on Japan and the Middle East, in the US and in the Eurozone, you're expecting to see marginally higher growth rates. What are the main reasons for this?
Well, the US certainly has performed a bit stronger than many people had expected. Their fiscal expansion plans, which of course most developed economies are already in austerity mode, but the US is not, so we're still seeing plenty of support from the economy. QE2 from the Fed is still feeding through. Fiscal expansion is still having an impact. And actually we started to see some signs that perhaps the labour market is coming back to life. The manufacturing sector is looking a bit stronger as well because export growth is doing rather better. And just the sense is that the economic indicators are all improving and perhaps improving on a sustainable basis. So in fact, when you look at our forecast for next year, despite the fact that we do expect by that point no more fiscal stimulus and perhaps even a little bit of austerity, we've actually revised up modestly our growth forecast for 2012 because we think the fundamentals are looking a little bit better than they were before. So in many ways, the very aggressive action that the Fed took and the fact that fiscal stimulus was kept in place for longer does seem to be combining to mean that the underlying dynamic within the US economy is a bit better than perhaps people had thought. So that's a very positive outcome.
And with regards to the Eurozone?
Eurozone, I think there's clearly a dual track story going on. Germany's still very strong and really strong because of exports and what we see going on there in terms of their exposure to some of these very fast growing emerging markets. In Germany, very strong at exporting to China. Interestingly, unlike markets like the UK, where we're actually not very good at exporting to the BRICS. So we see a story in Germany and perhaps some of the bigger economies within the Eurozone, which is still very strong. But you look around the periphery and really the story's not changed at all there. We still feel very negative about the prospects for growth around those peripheral countries. And of course, Europe at the moment is still trying to drag together a plan in order to keep the fiscal show on the road for those markets. That's not looking anything like as promising as I think many people were hoping. And as a result of that, we don't really see any relief for some of these marginal economies. In Portugal, still going to be very weak. Greece, of course, has accepted some more onerous terms in reduction in exchange for having the interest rate on their bailout package reduced. Ireland's not taken a similar kind of offer, which would involve them lifting their corporate tax rate in return for lower interest payments. So still a lot of strains around those peripheral economies, and we don't really see that changing. So Germany looks pretty good, but the rest not so good at all.
Thank you, Robin. Well, join us again next month for more analysis of world events on the Global Forecast. Until then, thank you and goodbye.